Congress introduced REITs 60 years ago to open up real estate investment to everyone. They offer investors, regardless of size, a simple way to include real estate in their portfolios. REITs have proven to be a solid investment over time. But what exactly are REITs? Well, a REIT, or real estate investment trust, is a company that invests in income-generating real estate. Individuals seeking real estate exposure can buy shares of a REIT, thereby integrating the REIT's real estate holdings into their investment portfolio. Let's take a closer look at why you should consider including REITs in your investment portfolio. And we'll share with you two of the very best high-dividend REITs to buy and hold to get you started. Strong long-term performance. REITs have consistently outperformed stocks over extended periods. For instance, the FTSE New REITs Composite Index, which measures REITs' performance, shows that over the past 45 years, REITs have generated a compound annual average total return of 11.4%, encompassing dividend and stock price appreciation. This is only marginally below the 11.5% annual return of the S&P 500 over the same time. REITs have generally outperformed stocks, including small cap and large cap stocks, over various time frames ranging from 3 to 40 years. Small cap stocks surpass REITs only in the past year. Additionally, REITs have consistently outperformed bonds in every historical period spanning the past 40 years. Appealing passive income. A key factor contributing to the strong long-term total return of REITs is that they generally pay attractive dividends. For instance, the average REIT yielded 4.09% in 2023, which is much more than a 3.23% dividend yield of stocks in the S&P 500. This consistent income stream becomes significant over time and forms a substantial portion of a REIT's overall return in the long run. REITs pay high dividends primarily because they are required to distribute 90% of their taxable income to comply with IRS rules. However, the majority of REITs often pay out more than 90%, largely driven by their higher cash flows from operations relative to net income. This phenomenon is influenced by the significant annual depreciation typically recorded by REITs. REITs have a solid history of consistently raising their dividend. Take Federal Realty FRT, for example. It boasts the largest history of dividend growth with 56 years in a row of dividend hikes. This REIT from the retail sector has survived recessions and other economic headwinds. Ease of conversion, liquidity. Investing in real estate comes with the challenge of illiquidity, meaning it's not easy to quickly convert property into cash. For instance, if you own a single-family rental property and need to sell it to cover a significant expense, you will have to put the house up for sale, wait for a reasonable offer, and pray that there are no complications before closing. Depending on prevailing market conditions, it could take several months before you successfully sell the property and access the cash, not to mention having to pay closing costs at a percentage to real estate agents. Conversely, if you're a REIT investor and need money quickly, you can simply access your online brokerage account and sell the REIT shares during the trading day. And you will not incur any fees for the sale, as most brokerage houses do not charge commission on REIT transactions. High transparency. Numerous private real estate investments function with minimal oversight, allowing real estate sponsors to sometimes make decisions that may not align with the best interests of the investors. This is not the case with REITs, as they maintain a high level of transparency. Independent directors, auditors, and financial media closely monitor the performance of REITs. Additionally, REITs are required to report their financial results to the SEC. This oversight acts as a safeguard for investors and helps prevent any unethical behavior by management. Risk-reducing diversification. REITs allow you the opportunity to spread your investments across the commercial real estate sector. This diversification helps decrease your risk profile without negatively affecting your returns. REITs offer diversification advantages because they generally align with the longer-term real estate cycle, which lasts around a decade or more. In contrast, bonds and stock market cycles usually run for approximately 5 3/4 years on average. tax advantages of REITs. Real estate investment trusts offer multiple tax benefits. First, for a fund to meet the REIT qualification, it must distribute to shareholders at least 90% of its taxable income every year. This means that REITs avoid double taxation by not paying taxes at the corporate level like most stock companies do. This allows you, the stockholder, to keep more of your returns as you are only taxed at the individual level. Utilizing tax advantage accounts for REIT investments can further amplify these benefits. Now that you know the benefits and advantages of investing in REITs, here are two high-dividend ones to get you started invested in REITs. They both yield in the 5 to 6% range, and the companies are on solid financial footing. The first company is from the office sector, Boston Properties, BXP, with a dividend yield of 6.8% as of March 2023. The second company is from the hotel and motel sector, Apple Hospitality REIT, APLE, with an average annual yield of 6.43% as of March 2023. While these are not anywhere close to being the highest yielding REITs you could buy, some of which pay in the high teens and 20s% range, they are companies that are solid, on a good foundation, and likely to sustain their dividend growth well into the future. REITs allow you to invest in more types of real estate than you would otherwise, with properties falling into one of various real estate sectors, including commercial buildings, healthcare facilities, residential housing, industrial, and others. REITs are a great addition to any portfolio, delivering robust returns along with other benefits such as dividend income and diversification. Go ahead, leave us feedback and share your thoughts in the comments. And if you find this information helpful, smash the like button, subscribe to the channel, and share the video with someone who can benefit from it. Until next time, stay financially savvy. We'll see you in the next video.